Chapter 9. Eldredge and Gould dredge up investing gold. Why should not nature have taken a leap from structure to structure? On the theory of natural selection, we can clearly understand why she should not, for natural selection can act only by taking advantage of slight successive variations. She can never take a leap, but must advance by the shortest, slowest steps. Charles Darwin, On the Origin of Species, Chapter 6, Difficulties of the Theory. Charlie and I decided long ago that in an investment lifetime it's just too hard to make hundreds of smart decisions. That judgment became ever more compelling as Berkshire's capital mushroomed and the universe of investments that could significantly affect our results shrank dramatically. Therefore, we adopted a strategy that required our being smart and not too smart at that only a very few times. Indeed, we'll now settle for one good idea a year. Charlie says it's my turn. Warren Buffett, Annual Letter to Shareholders, 1993. Look back upon your life. Yes, I know you will need to stop reading to reflect on the years gone by. Please do so and contemplate the events or moments that have made you. Life, work, business, all of it. Go ahead, take a deep breath, pause, and roll that reel backward. Done? All right. What did you see? Let me share the snippets of my movie. Most of my 5 decades on this glorious planet seemed to have passed in a blur. I could remember only a few moments spontaneously when my mother cried on losing her mother, when my history teacher praised me, when my father allowed me to drive his car, when the first company I interviewed for rejected me, when a herd of elephants chased us on a safari in South Africa, when the first company I invested in had a successful IPO, when I first saw my newborn son, well, you get the picture. I may be able to list maybe 30 such events, but not 3,000. It seems a bit odd since I have been alive for about 30 million minutes. Where are the remaining minutes? Were they all uninteresting? Is my life nothing but a long period of nothingness punctuated by moments to remember? What about your life? And what about life on our planet? Some moments may not be forgotten even a century from now. One came on January 11, 2020, when the Chinese media reported the first death of a person, a 61-year-old man, from an unknown virus. He had been a regular at the local seafood and poultry market in the city of Wuhan. Within less than 2 weeks, dozens of countries across the world started reporting infections from the same virus. On January 30th, the World Health Organization declared a global health emergency, and on February 11th, it named the disease caused by the virus COVID-19. In March 2020, the world witnessed what it never had before, a complete global shutdown. Future generations will accuse us of photoshopping images of the empty streets of Mumbai, London, Rome, and New York in 2020. And no photograph will capture the scale or depth of human suffering and hardship. Every equity market in the world started falling precipitously, and in the months of March and April, there seemed to be no end to the bottom. The Indian Sensex crashed 23% in March 2020. What were we at Nalanda to do in these unprecedented times? Maybe evolutionary theory could give us a hint. The absence of evidence is evidence of absence. In 1972, the paleontologists Stephen Jay Gould and Niles Eldredge published an essay that seemed to blow a reasonably large hole in the tower of classical Darwinism. Darwin's theory of natural selection makes a robust case for phyletic gradualism. Darwin theorized that natural selection eliminates unfit individuals so that only the better adapted will reproduce. If this continues long enough, a new species is imperceptibly created and the original species goes extinct. He makes his view on gradualism explicit in the concluding chapter of Origin, as natural selection acts solely by accumulating slight, successive, favorable variations. It can produce no great or sudden modification. It can act only by very short and slow steps. If this is accurate, we should find intermediate forms of species in the fossil record providing evidence of phyletic gradualism. Let's take the example of whales, which evolved about 50 million years ago from a 4-legged, land-dwelling vertebrate called Pakicetus. Figure 9.1 lists some descendants of Pakicetus, including Ambulocetus, Remingtoncetus, Protocetus, and Dorodon, which ultimately evolved into current-day whales and dolphins. Given the large size of whales, we should find hundreds, maybe even thousands, of intermediate forms. The problem is that we don't. For example, where are the intermediate fossils between Remingtoncetus and Protocetus? We have a decent fossil record that helped paleontologists piece together the puzzle of whale evolution, but we don't have most of the transitional forms. I discussed the evolution of giraffes in Chapter 5. If natural selection exterminated giraffes with shorter necks over time and the longer-necked ones evolved gradually, why have we not found giraffe fossils with necks ranging from very short to very long? Given that we haven't, how can anyone claim that evolution proceeds gradually and not suddenly? Intellect and integrity are mutually exclusive traits, one does not guarantee the other. However, Darwin was that rare genius who was also unsparingly honest. He penned an entire chapter on the potential problems with his theory. He starts chapter 6 of Origin, Difficulties of the Theory, by stating an obvious issue with the idea of natural selection. He argues that since natural selection gradually eliminates minor well-adapted forms, extinction and natural selection must operate simultaneously. Hence, logic dictates that innumerable transitional forms that were unable to adapt to their surroundings should have existed. But, as Darwin himself points out, transitional fossils have rarely been found. He admits that the incomplete fossil record poses a significant hurdle to anyone trying to prove that species evolve gradually. But he had a solution. He asserted that the geological record is incomplete. He stated, "The geological record is imperfect, and this fact will to a large extent explain why we do not find interminable varieties connecting all the extinct and existing forms of life by the finest graduated steps. He who rejects these views on the nature of the geological record will rightly reject my whole theory, emphasis mine." He considered the issue of a lack of transitional forms so devastating to the theory of natural selection that he went on to devote chapter 9 of Origin to a discussion of just this one problem, aptly titled, "On the Imperfection of the Geological Record." He made his case by presenting several convincing arguments. Only a tiny portion of the Earth has been geologically explored. An organism with only soft parts cannot be preserved. If shells and bones sink to the bottom of the sea where sediment does not accumulate, they will disappear. Many species, like land shells, existed in the distant past, but hardly any fossils can be found. If Darwin was right about gradualism, paleontologists should witness a gradual change in the fossil records over millions of years. But this is not what they find. Instead, before and since Darwin, a large number of paleontologists have found that the majority of species appear suddenly in the fossil record and then persist unchanged until they go extinct. Hugh Falconer, 1808 to 1865, was one of the greatest paleontologists of the 19th century. He went to India as a surgeon in 1830 but spent most of his time digging up fossils. He discovered ancient fossil beds in the southern Himalayas and excavated several extinct species like the mastodon and saber-toothed tiger. He also studied the fossils of European elephants. Darwin had colossal respect for Falconer and sent him a copy of the first edition of Origin in November 1859 with a personal note. Falconer discovered that most fossil species remained stable over very long periods, even through significant environmental changes. In his 1863 monograph, after describing that the mammoths had experienced extreme changes of climate, he wonders if species are so unstable and so susceptible to mutations through such influences. Why does that extinct form stand out so signally, a monument of stability? In 1903, the famous paleontologist H. F. Cleland noted a similar stasis in Devonian fossils from 420 to 360 million years ago. He stated, "A careful examination of the fossils of all the zones, from the lowest to the highest, failed to reveal any evolutionary changes with the possible exception of Ambochelia preambona. The evolution of brachiopods, gastropods, and pelecypods either does not take place at all or takes place very seldom." Many other paleontologists had been making similar observations. None of these practitioners defied Darwin's claim of gradualism, although their field observations seemed to indicate otherwise. This tension between theory and practice finally broke in 1972 when Niles Eldredge and Stephen J. Gould published their famous essay, Punctuated Equilibria, an alternative to phyletic gradualism. They claimed that the history of the organic world could be viewed as comprising long periods of stability interspersed with brief periods during which new species emerge. In the author's words, as a central proposition, punctuated equilibrium holds that the great majority of species, as evidenced by their anatomical and geographical histories in the fossil record, originate in geological moments, punctuations, and then persist in stasis throughout their long durations. Gould and Eldredge were admonishing their peers for confusing an absence of evidence with evidence of absence. Gould, who died in 2002, was a paleontologist at Harvard University and conducted extensive research on West Indian land snails. Eldredge, now curator emeritus at the American Museum of Natural History, specialized in trilobites, which are now extinct. Paleontologists study fossils to learn about an organism's evolutionary history and its relationship to other organisms and its environment. In fact, until the rise of modern DNA extraction techniques, paleontology was the only science capable of studying ancient life. But even the latest and most modern DNA extraction techniques can study samples of only up to about 1 million years old. So fossils, and hence paleontology, are our only reliable window onto the ancient past. Gould and Eldredge's brilliant insight pointed out what may seem obvious now: the gaps in the fossil record were not a bug, but a vital feature of the evolution of species. They declared that when paleontologists found a sudden change in the morphology of a particular species, they should assume that there had been a sudden change in morphology and not make the Darwinian error of trying to explain away this sudden change by invoking gaps in the fossil record. According to them, the absence of evidence of intermediate forms is evidence of their absence. Therefore, there was no need to take refuge in the theory of the imperfection of the fossil record. If a brief punctuation followed a prolonged stasis, we should not find any intermediate forms because there aren't any. In their seminal article, Gould presented evidence of sudden evolutionary change after long periods of stasis by analyzing the evolution of a Bermudan snail, Poecilozonites bermudensis, over 300,000 years into 3 species: P. b. fasolti, P. b. sieglandi, and P. b. bermudensis. He showed that sharp morphological differences in these 3 species, as measured by differences in color, the form of their spire, the thickness of the shell, and the shape of the apertural lip, did not arise gradually. Instead, they came about owing to a punctuation event of allopatric speciation, that is, a new species arising as a result of the geographic isolation of a small group of individuals from their parent species. Similarly, Eldredge outlined the evolutionary history of a trilobite species, Phacops rana, and presented evidence for the drastic changes in eye morphology of the various subspecies of P. rana arising out of punctuation events, not through gradual evolution. After Eldredge and Gould published their path-breaking article on the fossils of snails and trilobites, scientists discovered more examples of evolution through punctuated equilibrium across all of life, including animals, plants, bacteria, and even viruses, although whether viruses are life is debatable. In his research article published in 1985, A. Johnson studied 34 scallop species from the Jurassic period from 200 to 145 million years ago, and found copious evidence of stasis as well as an example of abrupt speciation. He concluded one case was discovered where the sudden appearance of a descendant form could fairly be ascribed to rapid evolution within no more than 1 million years. Box 9.1. There's no contradiction here. Punctuated equilibrium seems to contradict the observations made by Curtin and others as described in the previous chapter. Curtin had shown that the rate of change in organisms is higher over the short term and is lower over the long term. But the theory of punctuated equilibrium asserts that living things change dramatically, that is, create new species after a long period of stasis. What's going on? If you read carefully, you will notice that these theories actually complement each other. Curtin's observations were for a single species over thousands of years, and the changes observed were within reasonable limits. The grand beak measurements were spread over a few decades, and the variations in beak size and shape weren't so drastic as to warrant the creation of a new species. Eldredge and Gould, on the other hand, discussed the process of the creation of a new species after the original species has been in stasis for millions of years. Both views are correct. They are explaining different phenomena over different periods. Inconclusive evidence of gradual change over some 25 million years was discovered in one of the other lineages studied. But in the remaining 32 lineages, morphology appears to have been static. One of the most extensive documentations of punctuated equilibrium started as a research project to refute it. Alan H. Cheatham of the Smithsonian National Museum of Natural History in Washington, D.C. is an expert on bryozoan fossils. Bryozoa are tiny animals that look like worms and have tentacles on the outside. They live in colonies that resemble trees or flowers. He started his work on the bryozoan species Metrorhabdotos to illustrate gradualism. Cheatham measured 46 characters in 17 species of Metrorhabdotos over 15 million years. He found that 11 of the 17 species persisted unchanged for 2 to 6 million years, followed by a punctuational change over 160,000 years. Cheatham emphasized the remarkably clear-cut evidence for a punctuated evolutionary pattern in these Metrorhabdotos species. Many such studies have found evidence of punctuated equilibrium. One of the most interesting and conclusive was reported in the Proceedings of the Royal Society in 2008 by Tiina Mattila and Fomer Bachma from Umeå University in Sweden. Instead of examining fossil records, Mattila and Bachma analyzed the change in body mass of 2,143 mammal species of a total of 4,510 extant species to assess whether their evolution was punctuated or gradual. They concluded, our Bayesian estimates from mammals as well as separate subclades such as primates and carnivores suggest that gradual evolution is responsible for only a small part of the body size variation between mammal species. Their study confirmed that punctuated equilibrium played a big part in the evolution of most mammal species' body mass. Most research on punctuated equilibrium, including that by Gould and Eldredge, typically focuses on one species at a time. In contrast, Mattila and Bachma showed that the theory applied to the entire mammalian clade. Gould and Eldredge's essay has turned out to be highly controversial and has many supporters and detractors. Many researchers have found evidence of punctuated equilibria in species evolution and others haven't found any. The debates are fierce and even personal. The gradualists have called the punctuated equilibria principle evolution by jerks, and the other side has countered by calling the gradualist principle evolution by creeps. So much for scientific decency. One of the most significant sources of controversy is their use of the words rapid and sudden when discussing the birth of new species. The critics of punctuated equilibria accuse Gould and Eldredge of reviving the discredited mutationism theory of Hugo de Vries and the macromutation theory of Richard Goldschmidt. Goldschmidt, a German-born American zoologist, argued in his book The Material Basis of Evolution in 1940 that species were created not by accumulating minor variations but through significant mutations called saltations in a single generation. However, the scientific community has discredited this theory of sudden evolution, derisively termed the theory of hopeful monsters. Gould has rightly argued in many of his writings that punctuated equilibrium is not saltation. The theory was written for paleontologists who understand that instantaneous refers to geological time spanning tens of thousands of years and should not be confused with human timescales. In his book The Structure of Evolutionary Theory, Gould uses the analogy of human gestation as the gestation time of a human being represents 1 to 2% of an ordinary lifetime. Perhaps we should permit the same general range for punctuational speciation relative to later duration in stasis. At an average lifetime of 4 million years, a 1% criterion allows 40,000 years of speciation. A bizarre unintended consequence of the brouhaha among biologists was that the creationists crashed their party. Creationists have always used the lack of intermediate forms in the fossil record as evidence that Darwin's theory is wrong. The idea of punctuated equilibrium seemed to substantiate their claim when Gould and Eldredge emphasized that stasis is data. Creationists believe that animals and plants emerge suddenly in the fossil record because they were created instantaneously by God. Thus, they took refuge in the theory of punctuated equilibrium, which seemed to affirm the sudden emergence of species. Gould was scathing in his takedown of the creationists with the following choice words. Punctuated equilibrium provides an even easier target for this form of intellectual dishonesty or crass stupidity if a charge of dishonesty grants them too much acumen. No one should be surprised that our views have become grist for their mills and skills of distortion. I am not an evolutionary biologist, but as I said in the introduction, one of the skills I possess is the ability to read. I know that the famous biologists and philosophers of biology like Richard Dawkins and Daniel Dennett belittle punctuated equilibrium and claim that it's barely a wrinkle on Darwin's theory. Maybe. The issue for me is not whether Gould and Eldredge proposed something revolutionary, but whether what they offered was a new way to look at evolution and whether it stands up to empirical analysis. A search of punctuated equilibrium on Google Scholar, which searches only for scientific articles, throws up more than 85,000 results. Not all may be relevant, but a glance through the first few pages of these results clearly shows that scientists have gathered enough evidence for this phenomenon over the years. To a layperson like me, it seems that the theory of punctuated equilibrium did move Darwin's theory forward, as the research articles described in this chapter demonstrate. When I first read about the theory many years ago, my first thought was that life was all about not just biological life but life. No wonder a 2-hour movie can capture, or seem to capture, the entire life of Mahatma Gandhi, Frida Kahlo, Muhammad Ali, or Coco Chanel. Movie makers use punctuated equilibria to eliminate the stasis from the lives of heroes and celebrities, highlighting only the punctuations. History books apply the same technique to chronicle the life of an entire civilization over thousands of years by compressing narratives into a few hundred pages. On my desk lies a copy of Duff McDonald's book The Firm, The Story of McKinsey and Its Secret Influence on American Business, which compresses almost a century of the consulting firm's existence into a mere 400 pages. Now that I have seen the theory, I can no longer unsee it. It seems to apply everywhere I look. But let me not get carried away. Let's return to investing. Here are my main investing lessons from the theory of punctuated equilibrium. 1. Business stasis is the default, so why be active? 2. Stock price fluctuation is not business punctuation. 3. Take advantage of the rare stock price punctuations to create a new species. Business stasis is the default, so why be active? In the business world, as in the organic world, stasis is the default. Great businesses stay great. Bad businesses remain bad. Yes, I know. Off the top of your head, you can name an incredible business in deep trouble, so can I, SoftBank, and a lousy business that has revived from the dead, so can I, SoftBank. This assertion about business stasis is not about starting a battle of anecdotes. My contention is not that counterexamples don't exist, but that we should be more concerned about dominant relative frequency, an apt term I learned from Gould's magnum opus, The Structure of Evolutionary Theory. He argues that punctuated equilibrium does not merely assert the existence of a phenomenon, but ventures a stronger claim for a dominant role as a macroevolutionary pattern in geological time. Similarly, my 3-decade-long journey in the corporate world has led me to believe that great businesses stay great and that, more often than not, bad businesses stay bad. Allow me to clarify the meaning of some words. Stasis does not mean static. A corner store in your neighborhood selling the same products since you were a toddler is static. The corner store hasn't changed. Dollar General, a variety store chain that sells deeply discounted products across more than 16,000 stores and grew its revenue 2.5 times between 2011 and 2021 to $33 billion, is in stasis. The character of Dollar General hasn't changed. I am excluding industries in which greatness and badness haven't had time to settle. These include areas like AI, space travel, autonomous vehicles, food delivery, WeWork clones, quantum computing, nanotechnology, and other sectors into which substantial venture capital investments are pouring. I wish I could apply deductive reasoning. All humans are mortal. Socrates is a human, therefore Socrates is mortal, to prove without doubt that the great and not so great businesses stay in stasis over long periods. But, unfortunately, I cannot find such a route, so as usual, let me take the inductive path by presenting you with multiple strands of evidence. I have divided this section into 4 parts, each of which separately asserts that great businesses remain outstanding and that inadequate businesses continue to underperform. Of course, none of these sections makes an infallible argument. Hey, this is investing, not linear algebra. But taken together, I hope to make a convincing case for the third leg of our investment philosophy. Don't be lazy, be very lazy. Part 1. Proof from personal experience. Don't you detest arguments that take refuge in personal anecdotes? We Homo sapiens can reason, rationalize almost anything. We have spotted UFOs, witnessed election fraud, not worn masks during the COVID-19 crisis, and believed that baseball is somehow superior to cricket. However, in this case, in which I need to show that stasis is the default for businesses, I ask that you give me some leeway for 2 reasons. First, I have been in the business world for almost 35 years, and at some point, anecdotes can transform into patterns. Second, this belief is not the result of armchair philosophizing but the very foundation of how we manage money for our clients and for ourselves. Almost all my wealth is in my fund. Not believing in the right way to manage money will cost me serious money. My first job was as a production management trainee at Unilever in India in 1989. Unilever had, and I believe continues to have, an exceptional training program for its new managers. During my first year, I circulated through all the critical departments of Brooke Bond, a Unilever subsidiary that manufactured and sold tea and coffee. I remember my 4-week stint at the sales office in the city of Coimbatore in South India. Every day I went to the market with the sales officer, who should have been called the no-sales officer. On paper, his job was to sell tea, but in reality the dominance of Brooke Bond's brands compelled him to ration the orders to the various retailers clamoring for more tea. The respect and awe he commanded would have shamed many local political leaders. Unilever has maintained its preeminent position in tea and dozens of other consumer products in India over many decades. It was exceptional in 1989 and it is exceptional today. For example, Unilever's subsidiary listed in India, Hindustan Unilever, has a market value of almost half that of its parent listed in the United Kingdom. The same phenomenon has been confirmed across many other product and service categories in India over more than 2 decades: toothpaste, Colgate, chocolate, Nestle, cars, Maruti Suzuki, innerwear, Page, consumer electricals, Havells, biscuits, Parley, Britannia, hair oil, Marico, paint, Asian Paints, Berger, tires, MRF, diagnostic services, Dr. Lal, IT outsourcing, TCS, Infosys, kitchen appliances and cookware, Hawkins, TTK Prestige, herbal supplements, Dabur, and many more. Whichever country you are in, I bet you may have noticed the same phenomenon in many industries. Most of the leading players of the 1990s or early 2000s are the leaders today. The new age internet businesses have taken this continued dominance to a level unseen in almost any other era, whether Amazon, Facebook, Google, Twitter, or Uber. Stasis is the default. Since great businesses remain great for an eternity, everyone knows about them. Investors bid their prices up, and rightly so. The 10-year average price-to-earnings (PE) multiples of some of the leading consumer businesses in India are astronomical. For example, Asian Paints, 56, Colgate India, 43, Dabur, 44, Hindustan Unilever, 51, and Page Industries, 65. As price-sensitive investors, we should not buy these businesses since their valuations would almost always be too high for us. And we don't. From the list provided 2 paragraphs earlier, the only companies we have been able to buy since 2007 are Page, Havells, and TTK Prestige. Our window of opportunity for buying these 3 was only 2 to 3 months over almost 15 years, a punctuation event that lasted just 1 to 2% of this period. There are very few great businesses and they are almost always unbuyable. Hence, we buy very rarely, and when we do, we buy a lot. So, having purchased these winners, given the stasis of their success, why should we sell? Part 2, The Fate of the Fortune 500. I want to revisit the comparison of the Fortune 500 lists from 1955 and 2015 detailed in Chapter 8. We saw that a plausible case could be made for 40 to 45% of the Fortune 500 businesses of 1955 maintaining their excellence for 60 years. Of course, this is not perfect stasis, nor is organic life in pure stasis, as we saw earlier in this chapter, but it sure is a pretty good case of long-term stasis. Thus, if we were an owner in a collection of these excellent businesses, and I know that is a very big if, it would have made no sense to sell and leave. As a portfolio, not necessarily individually, the businesses in this group should have done well for us. With a reasonable degree of confidence, we can state that at least 40 to 45% of the largest 500 U.S. businesses in 1955 performed exceptionally well over 60 years. Stasis was the default for this group of companies. Here is another way to look at stasis. Let's shine a light on the businesses that did not make it. We saw that at least 40% of businesses, about 200 from the 1955 list, maintained their excellence for 60 years until 2015. How many firms, both private and public, in 1955 could have made it onto the Fortune 500 list in 2015 but did not? Would 10,000 be a fair estimate? That is probably a highly conservative guess because businesses would have had 60 years to make it onto the list, and we are not counting the thousands of businesses created after 1955 that could have made it to the list in 2015. Anyway, let's stick to 10,000. Of these 10,000 in 1955 that could have made it to the 2015 Fortune 500 list, only 300 did. The remaining 200 had stayed on the list for 60 years. An apparent 3% success rate. The actual number is probably closer to 1 to 2% or even lower. Thus, 97 to 99% of the not-so-great businesses could not succeed over 60 years. Stasis is the default. I know I have been unfair here. To count listing among the Fortune 500 as a measure of success is undoubtedly an unreasonable demand. Many of the 10,000 businesses of 1955 may have achieved great success without necessarily becoming too large. They may have focused much more on profits or may have been merged or acquired, creating massive value for shareholders. My intention here was to demonstrate directionally that great businesses remain great much longer than we think. The probability that a not-so-great business becomes excellent over time is infinitesimal. Our investment strategy is thus quite simple. 1. Since the vast majority of businesses do not become great, our default strategy is not to buy. We are lazy buyers. 2. We buy only if we can find a high-quality business that can stay in stasis over decades. If we believe we have such a business, we don't sell. We are very lazy sellers. Part 3. A conclusion from climbing concentration. In an article from the July 2019 issue of Review of Finance, Grullon, Larkin, and Michaeli ask, are U.S. industries becoming more concentrated? It turns out to be a rhetorical question. Of course they are. The authors demonstrate this with copious data. Their article shows two trends occurring from 1997 to 2014 that seem to reinforce each other. 1. Since the 1990s, in over three-quarters of U.S. industries, the market share of the leading players has increased, and 2. These companies show higher profit margins and provide higher returns to shareholders, which, in turn, allows them to increase their market power even more. While the article does not state so explicitly, it is also evident that the market power of smaller and less powerful businesses has declined over this period. The authors show that not only did the revenue share of the four largest public and private companies in almost every industry increase, but also that the average size of the leading companies also tripled in real terms during the period of measurement. And this is not a recent phenomenon. It turns out that the specter of increasing market power among the more extensive and more successful businesses has haunted the corporate world since the beginning of the 20th century. In 1977, Leslie Hanna and J.A.K. published Concentration in Modern Industry, Theory, Measurement, and the UK Experience. Hanna and Kay demonstrate the inexorable rise of the biggest firms' market share in the United States and the United Kingdom from the early 1900s to the mid-1970s. The first graph in the book tracks the share of the largest 100 firms in manufacturing net output during this period. Over 70 years, the market share of these firms rose from 15% to 50% in the United Kingdom and from 20% to more than 30% in the United States. Hanna and Kay claimed increasing market power, which cuts across industries, and not increasing industry concentration, which measures the increasing power of companies within an industry. Ideally, I would like to demonstrate greater industry concentration to make my case, but it is still instructive to note the longer-term success of the largest firms in the United States and the United Kingdom. A January 2019 OECD working paper titled Industry Concentration in Europe and North America presents evidence for the increasing power of more successful firms quite emphatically. Between 2001 and 2012, the largest 10% of companies in the average industry in 10 European countries increased their market share by 2 to 3 percentage points. In the United States, the increase in market share of the leading firms of the average industry between 2000 and 2014 was 4 to 8 percentage points. The paper also clarifies that the numbers were not driven by digital-intensive sectors, example, search engines, social media, e-commerce, but by old-world manufacturing and services firms. In March 2016, The Economist magazine's cover bemoaned, "Winners take all, why high profits are a problem for America." Of course, I am not qualified to pass judgment on the appropriateness of the sky-high profits of giant corporations, but I do want to quote the magazine's view on the stasis of businesses. The article discusses three key reasons: technology, globalization, and decline in trade union membership for profit accumulation among the more successful firms, and then follows with the following. None of these accounts, though, explain the most troubling aspect of America's profit problem, its persistence. It mentions that a highly profitable firm in 2003 had an 83% chance of being very profitable in 2013. A powerful visual plot of the share of the top 4 companies in 893 industry sectors from 1997 to 2012 clearly shows the increasing power of larger businesses. The summary of all this research on industry and market concentration is as follows. 1. There are a few large and successful firms in most industries. 2. These successful companies are becoming even more successful. 3. Weak companies are getting weaker. Numbers 1 and 2 are direct conclusions of the research, and number 3 is an indirect but logical outcome of 1 and 2. As I wrote earlier, our investing experience in India is not different from what research from the United States, the United Kingdom, or Europe says. Our investee companies have been gaining share over the competition over decades. Some examples are Berger in the paint industry, Supreme in plastic pipes, Voltamp in industrial transformers, Page in innerwear, Havells and V-Guard in consumer electricals, Amara Raja in batteries, Info Edge in job boards, MRF in tires, and Ratnamani in specialty steel pipes. In India, too, great businesses continue to be great and poor businesses continue to suffer. The observation that stasis is the default does not respect national boundaries. As permanent owners, we want to own successful businesses that will maintain their rewarding run. That sounds straightforward, but the problem is that there are very few successful businesses. Throwing a dart at the business landscape will land us in real trouble. So we don't. We invest rarely. We should not sell once we own a winner like Havells or Ratnamani since it will likely keep gaining market share. So we don't. We sell even more rarely than we buy. Part 4, The Narrative of a 90-Year Study. In May 2018, Hendrik Besembinder of the W. P. Carey School of Business at Arizona State University published an article titled "Do Stocks Outperform Treasury Bills?" He analyzed the price performance of about 26,000 common stocks listed on the New York Stock Exchange, the American Stock Exchange, and the Nasdaq from 1926 to 2016. Unsurprisingly, 51% of these stocks lost their entire value over their lifetime. The majority of businesses should not be in business. Besembinder's research demonstrates that since the average common stock will lose its value over time, owning stocks can harm one's wealth. Our default position should be not to buy. So we don't. We're lazy. Can you guess the number of those 26,000 stocks if purchased in 1926 and held until 2016, or acquired or merged, that beat the market? The answer is about 8,000, or about 31% of the universe. Again, I was surprised at how high this number was. Remember that we are talking about the companies not just doing well but beating the market over 90 years or until they were merged or acquired. These great businesses maintained their greatness over a very long period. Stasis was the default for them. Once we owned such a business, selling would border on being sinful. Stock price fluctuation is not business punctuation. A critical element of the theory of punctuated equilibrium is that fluctuation is not punctuation. During long periods of stasis, the character traits of living organisms do vary but within limits. A critical element of our investment philosophy is that we do not confuse stock price fluctuation with business punctuation. During long periods of business stasis, stock prices vary, but the character of excellent businesses tends to stay within limits. As Gould clarifies, stasis does not imply absolute stability, but rather directionless fluctuation that generally does not stray beyond the boundaries of geographic variation within similar species and, particularly, does not trend in any given direction, especially towards the modal morphology of descendant forms. The character traits of species do fluctuate while they are in stasis, but they are range-bound. There is a tendency among investors to interpret stock price movement as the measure of business direction. Shouldn't it be the other way around? Does the cart drive the horse? You bet it does, more often than you can imagine. And it does strange things to even the best of us. Our community can and does accord a level of priority to ticker symbols that they don't deserve. Here is a true story. A venture capitalist VC friend and I were meeting for lunch one afternoon in Mumbai. As you may know, VCs invest in startups and early-stage privately held businesses. Every few minutes, he would glance at his phone and then return to our conversation. I had known him for more than a decade but had never witnessed this odd behavior before. After a few minutes, I became mildly irritated and asked him the reason for his distraction. He apologized and sheepishly remarked that 2 of his portfolio companies had gone public in the past 2 weeks. After that, he said he felt compelled to check their stock prices every few minutes. He admitted that he couldn't help himself. My friend is an intelligent guy. He knows that the business of his listed portfolio companies is not changing by the minute. A few weeks earlier, when the companies were unlisted, he hardly ever thought about them. But now that they each had a stock exchange ticker that gyrated a few percentage points every day, he had gotten caught up in the action. Now imagine if he were running a public market fund like ours in which every portfolio company is listed. That may have driven him up the wall, which is what happens to many in our community. A great example of stock prices getting the upper hand is provided by Amazon. The company had its IPO in May 1997 at $18. By December 1998, when dot-com mania was sweeping through the U.S. markets, the stock had climbed almost 14 times to $243. The star analyst at CIBC Oppenheimer, Henry Blodgett, published a price target of $400 within 12 months. The stock promptly jumped almost 20% to $289 in one day. In January 1999, Blodgett wrote, "Unlike with other famous bubbles, the internet bubble is riding on rock-solid fundamentals, perhaps stronger than any the market has seen before." Well, where was the evidence? None of the rising dot-com stars was even close to earning any profit. Worse, they were burning cash as if the market faucet would remain open forever. The only empirical evidence backing Blodgett's claim of solid business fundamentals seemed to be that the stock prices were rising. By the time the dot-com bubble burst in the summer of 2000, Amazon had dropped more than 60% from its peak. Ravi Surya, a young Lehman Bond analyst, issued a withering 27-page report predicting that Amazon was doomed and that if the company did not change its ways, it would be out of cash within a year. In this highly bearish environment for all dot-coms, Amazon fell 19% in a single day. Bezos brushed the criticism aside and Amazon kept doing its business the way it had always done, by caring more about cash flow than profits. Surya had predicted that Amazon would be left with $125 million in the bank at the end of 2001. Instead, Amazon ended the year with $1 billion. Amazon's bonds, which Surya had predicted would collapse, were up 50%. Just as Blodgett had gained stardom by predicting that Amazon would keep rising, Surya became the darling of financial pundits with his prediction that Amazon would fail. The only difference? Blodgett was cheerleading when all stocks were rising, and Surya predicted doomsday in the middle of a catastrophic bear market. It is unfair to pick on only Blodgett and Surya. They were two among thousands of analysts and investors who got carried away by the rising and falling stock prices of the dot-com era. The saga repeated itself during the global financial crisis of 2008 when the rising market capitalizations of highly leveraged lenders blinded most financial experts to the deepening malaise that finally brought the global economy to its knees. In my opinion, investors can commit two types of grave errors. First, they can treat an unfavorable stock price fluctuation as a negative business punctuation. This mindset compels the investor either to sell a good business or not to buy a good business when the price declines owing to a negative piece of news or event. I covered this first error in the previous chapter when discussing the Grant Curtin principle of investing, GKPI. As a reminder, GKPI says the following: when we find high-quality businesses that do not fundamentally alter their character over the long term, we should exploit the inevitable short-term fluctuations in their businesses for buying and not selling. Since Chapter 8 addressed this issue, let me not dwell any more on it here. The second error is to regard a positive stock price fluctuation as positive business punctuation. Doing so can lead to buying a lousy business because it seems that things have permanently improved or not selling one. Ask any long-term investor about their investment strategy and almost all will proclaim that they buy and hold high-quality businesses. I doubt even one would admit to buying poor-quality businesses to trade later at a higher price. They are not lying. Then why is the portfolio of many funds filled with the latest SPAC? Who knows? FOMO, envy, greed, and some other quality human attributes probably play a role. It doesn't matter. These investors changed their minds about the quality of a business based on some positive evaluation of the opportunity. We see the same news flow as everyone else. We often see industry brethren rake in moolah by investing in airlines, real estate, infrastructure, education, public sector banks, that is, government-owned banks, or some other hyped-up Indian industry that does not live up to its expectations. How have we avoided succumbing to the temptation of investing in a bad business on a stock market or even a private market upswing? By following 3 simple rules. No sweets in the fridge. My wife has a sweet tooth but is also very health-conscious. Over more than 2 decades, she has followed a simple yet powerful way of avoiding the enticement of desserts. Our fridge just doesn't have any. In my view, the best way to avoid investing in bad businesses is to ignore them and their stock prices. We never discuss what we consider bad companies or industries in our team meetings. Never. It doesn't matter if an airline has declared spectacular results recently or if every analyst recommends buying airline shares. We are indifferent to a public sector bank that has hired a new CEO from the private sector and has pushed its stock price to an all-time high. We ignore an infrastructure business that has been awarded a new multi-billion-dollar contract and a gold loan business that has announced 30% ROE in its latest quarterly result and is touted by the bulls to be the next billion-dollar opportunity. No one on our team is allowed to utter the famous last words of many investors. This time, it's different. If we never discuss a business, how will we ever buy it? No sweets in the fridge, no snacking possible. The origin of every lousy investment is a good story. Table 9.1 shows many examples of Indian industries that became newsworthy after rising stock prices or soaring private market valuations. Take infrastructure. Anyone who has been to India knows that the country needs quality roads, power, ports, airports, and water. While the national highways in India are now better than highways in the United States, that's not saying much. In the mid to late 2000s, many investors salivated at the billions, or was it trillions, of dollars that were waiting to be made by investing in Indian infrastructure. The valuations of private and public companies were soaring, and there seemed to be a consensus that the gold rush was beginning. Amid this infrastructure mania, Reliance Power launched an IPO in January 2008 that was oversubscribed 72 times. It made the company's owner, Anil Ambani, the richest Indian. Despite having a power capacity of less than 1,000 megawatts at the time of the IPO, the company's value was about $35 billion. Did this lead to a large number of IPOs for infrastructure businesses that investors lapped up hungrily? Does the sun rise in the east? Both private and public equity investors in the hyped-up story of Indian infrastructure forgot or chose to ignore some uncomfortable truths. Every infrastructure business is held hostage to the whims and fancies of the government. The government hates to be a paying customer. Underpayment and late payment are the rule, not the exception, and even if the government behaves well, the returns on these projects are capped according to law. So why would we want to spend a single minute debating if any power business is worth investing in? We did not discuss a single story listed in Table 9.1 in our team meetings. We ignore the stock prices and businesses of businesses we detest. By the way, that doesn't mean that we are right to do so. Some investors may possess the skill to trade in and out of low-quality businesses, and that's fine. They have my admiration and best wishes. The market value of Reliance Power at the end of 2021 was $600 million, down 95% from its peak. Business knowledge, not stock price data. As I discussed earlier, we ignore many conspicuously poor-quality industries like power, infrastructure, and airlines. But most industries and businesses don't fall neatly into this category. So what do we do when we see increasing valuation in businesses or industries that we haven't encountered before? We ignore the hype around valuation and focus exclusively on business quality. I have devoted the whole of Section 2 to this topic, so let me confine this discussion to an example. Table 9.1 includes the news item, the education sector will grow at 7.5% to $144 billion by 2020. This headline is from late 2017 when many new age education companies, appropriately christened EdTech in India, had started getting funded at unheard of valuations in the private market. We don't know of a single listed education business in India that has made money over the long term. However, many have had soaring stock prices over the years with the unfulfilled promise of untold riches that would accrue to an intrepid investor. One did appear to break the mold, but sadly and predictably turned out to be a fraud. When I assess the finances of listed education businesses in a large market like the United States, I find that most don't earn even their cost of capital. For example, in 2021, the U.S. education company with the most considerable market value was Grand Canyon Education, whose market capitalization was only about $4 billion. It's a dangerous place to be. So what should we think about the dozens of Indian edtech unicorns or soon-to-be unicorns? I just do not have enough information to know. At their current rate of blowing cash that would put Usain Bolt to shame, they will probably not enter our radar until 2032 because they would need to have demonstrated at least a 5-year history of being highly profitable. For us, their soaring valuation is not an indicator that they are great businesses but that they have mastered the art of raising capital. Until the business numbers, example, our OCE and free cash flow, not revenue growth, become attractive, we refuse to engage with companies, and edtechs are no exception. Do we want to own this forever? Our best protection against getting swayed by a false positive, a stock price fluctuation that makes a lousy business look better than it is the question we pose for every investment. Do we want to be permanent owners of this business? Are we absolutely sure that we are willing to live with it permanently? Are we willing never to sell it? We presume guilt until innocence is proven. Our starting hypothesis with every business is that we don't want to own it. As you have seen throughout this book, a business needs to jump through several hoops before we choose to be permanent owners in it. One of India's largest real estate companies launched a $2 billion IPO in July 2007. Its stock price shot up by 70% before the end of the year. News anchors screamed until they were hoarse about the unlimited potential of Indian real estate. A journalist friend told me that it was easier to get an appointment with a Bollywood star than a real estate entrepreneur. We launched Nalanda in June 2007, smack in the middle of this frenzy. We did not make a single real estate investment because we did not want to be permanent owners in a real estate business. The reasons were many, but let me just state the first one so I don't even have to go on to the second. Real estate businesses in India aren't known for Gandhian governance, to put it mildly. What about the company today? The stock price is down 75% from its peak. Given its bloated balance sheet, the company has also had to raise multiple equity funding rounds in the past few years, diluting existing shareholders. The suffering for the owners of this business seems endless. We have saved a lot of heartburn by studying business quality while ignoring stock prices. We have stayed focused on getting married and have eschewed casual hookups, to draw an analogy from the dating world. A world intent on swiping left and right at breakneck speed probably finds it very hard to notice a marriageable candidate even when that candidate has been staring at them for decades. That gives us a competitive advantage we never asked for and probably didn't deserve. But we will take it. Thank you very much. Take advantage of the rare stock price punctuations to create a new species. Eldredge and Gould's bold claim was not just that organisms changed their morphology during punctuation events, but also that these events created a new species. As they elaborate, the theory of punctuated equilibrium attempts to explain the macroevolutionary role of species and speciation as expressed in geological time. They disagreed with Darwin's claim of speciation through gradual change. Biologists call this process anagenesis. Instead, they focused the minds of paleontologists and evolutionary biologists on the punctuation events that gave birth to novel species. Suppose you agree with the premise that markets are usually quite efficient and that it is very hard to buy high-quality businesses at an attractive valuation. In that case, it should be evident that long-term investors like us must take advantage of stock price punctuation events to create a new and improved portfolio. Let's return to the question I asked at the beginning of the chapter. As the COVID-19 pandemic created panic across the world, what were we at Nalanda to do in these unprecedented times? We bought a lot. Since our inception in 2007, we have bought only at times of adverse stock price punctuations. In other words, we have bought only when a stock is being abandoned by investors owing to an adverse macro event, industry troubles, or pessimism regarding a company's prospects. On 3 occasions, the global financial crisis, the euro crisis, and the COVID-19 pandemic, all 3 combined to offer us an unprecedented buying opportunity. Talk is cheap, so let me share some actual numbers. Table 9.2 presents the 3 main occasions over 14 years from June 2007 until June 2021, when we took advantage of stock price punctuations to dramatically alter the character of our portfolio. There were 169 months from June 1, 2007 until June 30, 2021. We invested a total of $1.86 billion during this period. However, as you can see from Table 9.2, the pace of investment was highly punctuated. We invested $851 million, or 46% of the total amount invested from 2007 to 2021, over only 26 months, 15% of the total number of months. Months of severely damaging market punctuations. The impact of the COVID-19 pandemic's negative punctuation on our buying behavior was even starker. We invested 22% of our capital in just 2% of the period of our existence. That is because, as shown in Table 9.2, we invested $405 million, 22% of our total capital invested over 14 years in only 3 months, from March to May 2020. Which comprises 2% of the 169 months. What I have not shown in Table 9.2 is our investment pace during March 2020. We invested 16% of our capital in 0.5% of working days. As the Indian Mid-Cap Index declined 28% during March 2020, we invested $288 million, 16% of the total amount invested until June 2021 over just 17 days. 0.5% of about 3,500 working days over 14 years. This amount, $288 million invested in March 2020, exceeds the amount invested in 12 of the 14 calendar years since our inception. The only 2 calendar years during which we invested more than $288 million are 2011, $320 million, and 2020, $486 million. Call us what you want, but scared we aren't. I guess we can all agree that we would make a sloth envious with our rare bouts of activity. So what do we do the rest of the time? We wait. Occasionally, we have had to wait many years. For example, we invested only $34 million and $66 million in 2018 and 2019, respectively. The amount we invested in 2020 turned out to be 45% more than in the previous 5 years combined. But I could have done a much better job. You may have noticed that we did invest a fair bit, $182 million, as the market panic started gathering around the global financial crisis, but we could have and should have invested a lot more. My excuse is that I had just started the fund in June 2007 and had not done enough work on enough companies to take advantage of the panic. The Occam's razor explanation is that I was a moron. Don't use the past tense, my wife reminds me dutifully. Table 9.2 shows the data on the overall market levels during 3 punctuation events. But we don't buy the market, we are interested only in quality businesses. Hence, it would be nice to find out the extent of the negative punctuation in the companies we bought. We had been tracking many businesses for years and we were well prepared when the pandemic panic struck in March 2020. During March 2020, we bought 8 businesses and continued to buy them until May 2020. Our previous monthly record was in October 2008 when we bought 6 companies. Lehman had collapsed only a few weeks earlier on September 15, 2008, and we had started gorging on quality enterprises. So yes, we waited almost 12 years before getting hyperactive. And you thought the comparison to a sloth was an exaggeration. Table 9.3 lists the 8 businesses we bought between March and May 2020. 4. MRF, Sundaram, Thermax, and Thyrocare were new to the portfolio and the remaining 4 were existing companies. We had been waiting to buy these 8 for many years. For a few, our wait had lasted more than a decade. Just as it does in nature, this rare punctuation event dramatically altered the nature of our portfolio. We were able to buy companies at prices and in quantities we never thought possible. For example, in Table 9.3, check out the discount at which we bought WNS, a business we have known well, since it is in our portfolio since 2008. In February 2020, it was trading at almost $74 per share. Within a few weeks, by March 2020, the pandemic scare had crushed the stock, allowing us to deploy almost $100 million at only $46 per share. Similarly, we bought Thermax, a business we had been tracking for more than a decade, at a 45% discount to its previous high in early 2018. Remember that in March 2020 there was no discussion of vaccines, the world was reeling under a pandemic that no one had ever seen before and it was impossible to predict how things would turn out. The world was shell-shocked and rightly so. During this period of hyperactivity from March to May 2020 we were often asked, why are not you waiting for things to get worse before buying? My answer was, we can't. We have a straightforward rule that is also easy to implement. Buy when the price is right. Unfortunately, not everyone follows this rule. As implied by the question, a widely practiced rule is to buy when the time is right. That is also a straightforward rule, but is it easy to implement? We follow the former because we know the price we want to pay for the business we want to own. It may or may not be the right price, but we know it for sure. We have no way of figuring out the right time. Maybe some folks do. Good for them. There is another way to answer this question. Long-term investors, including us, always claim that we are buying businesses, not stock prices, because this is what Buffett has been saying for decades. As a philosophical outlook, this is generally deemed a sensible strategy. But what does that statement mean? For us, it means the following. Let's say we have valued a business at $100 per share. If the stock price falls to $100 and our business assessment remains unchanged, we buy as much of the business as we can at or below $100. We then tell ourselves that this is a private business that we will own forever, and while it happens to be listed, the stock prices quoted by the ever-fluctuating markets are irrelevant to us. As a result, we don't care if the business quotes at $50 or $75 or $500. We are public market investors, but we behave as if we are investing in private businesses for all practical purposes. An afterthought, there is almost no business in our portfolio that we could buy at an absolute bottom, including the ones listed in Table 9.3. If you are searching for an abysmal market timer, look no further. Our 2008 to 2009 and 2011 investments have primarily turned out well. I don't know if our aggression in 2020 will yield fruit. But I am happy about our process, which was in our control. The outcome will be what it will be. We will know in 8 to 10 years if we were foolish or intelligent. Don't you love long-term investing? A housefly lives for a month, a mosquito for 1 to 3 months, and a cockroach for up to 6 months. Unfortunately, most insects live only for a brief period. There is one notable exception, though. 3 species of periodical cicadas found in the United States can live for up to 17 years. After hatching, baby cicadas, called nymphs, spend 17 years underground feeding on the roots of plants and trees. After that time, the adults emerge together in billions, some say even trillions, beginning in the second week of May, get into a mating frenzy, lay their eggs on trees, and are dead by the end of June. The eggs hatch in about 6 weeks, the nymphs drop down from the trees and burrow underground, and the 17-year cycle begins again. This evolutionary strategy, called prey satiation, has been supremely successful for eons because no predator can consume such a large number of cicadas in just a few weeks. There are currently 12 groups, called broods, of 17-year cicadas. In May and June 2021, enormous broods called Brood X, meaning 10, emerged mainly in Pennsylvania, Virginia, Indiana, and Tennessee. We will see them next in 2038. Our patience for a punctuation event seems pedestrian compared to the remarkable restraint of the cicadas. They wait 17 years for a life-changing event. We have had at least 3 during just 14 years. When will we witness the next one? I have no idea. But I know this. As a species, we investors are nowhere as disciplined as the cicadas. Our community will take things to an extreme before all hell breaks loose again. We are waiting. Chapter Summary. Evolutionary theory has taught me that reimagining investing requires us to accept the pervasiveness of business stasis. In other words, great businesses generally remain great and bad businesses generally remain bad. 1. The theory of punctuated equilibrium contends that evolutionary change occurs quite suddenly after long periods of stasis, not through a gradual process as claimed by Darwin. Stasis is the default in the natural world except when punctuations arise to create a new species. 2. Stasis is the default in the business world, too. Great businesses generally stay great and bad businesses generally remain bad. This is evident not only from my personal experience of investing in India over a few decades but also from empirical data from the United States on the longevity of high-quality businesses. 3. Not all fluctuations in the long-term evolution of an organism are punctuations. Over a period of stasis, organisms do vary within limits. 4. We do not confuse stock price fluctuations with business punctuations. This has allowed us to be aggressive buyers 3 times in our history, including during the market panic of the COVID-19 pandemic. 5. We avoid investing in bad businesses when their stock prices are on an upswing by focusing on the bad quality of the business and asking ourselves if we want to own it forever.